Monroe Capital caught our radar here at Insightful Value because the stock looks unusually cheap. But is this a hidden opportunity or a warning sign? Stick around as we unpack the numbers, the risks, and what the market might be missing. This review is for informational and educational purposes only and does not constitute financial advice. Make sure to subscribe to the channel and like this video if you find value in no-nonsense breakdowns like this. Monroe Capital is a US-based business development company. That means it provides direct lending, primarily to lower middle-market companies that are too small to access traditional bank financing. The company focuses on senior secured loans, unitranche financings, and other credit solutions to firms across healthcare, media, retail, and software. In other words, Monroe acts like a private bank for smaller companies that need capital but don't want to give up equity. So why is Monroe Capital's stock trading near its lows? Let's start with performance. In the most recent quarter, Monroe reported total investment income of around $17 million and net investment income per share of 22 cents, roughly flat versus the prior period. The dividend, currently 25 cents per share per quarter, remains intact and fully covered by earnings. That gives it a yield of over 14% at current prices, which sounds great, but comes with caveats. Monroe's net asset value per share has been slowly declining, now around $10.33. That erosion reflects both unrealized losses and credit stress within parts of its portfolio. Some loans are underperforming, and the overall non-accrual rate has ticked up. That's one red flag for income-focused investors. Additionally, Monroe has a relatively high leverage ratio for a business development company, over 1.4x debt to equity, which magnifies both returns and risk. From a value analysis perspective, Monroe is interesting. You're getting a high dividend yield, a portfolio of senior secured loans, and a share price trading well below net asset value. The company also repurchased some of its own shares in 2024, showing that management believes the stock is undervalued. But whether that's enough to counter credit quality concerns is the real question. Why consider investing in Monroe Capital now? If you believe credit conditions will stabilize and interest rates stay high, Monroe could benefit from elevated income on its floating rate loans. The discount to net asset value gives some margin of safety. Plus, the dividend yield is among the highest in the BDC space, and management has shown a willingness to defend it. Why might you avoid it? If the economy worsens or more portfolio companies miss payments, Monroe could face real trouble. Further write-downs might pressure the net asset value, and the dividend, while currently covered, is not guaranteed. Unlike large diversified lenders, Monroe is focused on smaller firms, which tend to be more exposed during economic downturns. The dividend history tells a story too. Monroe cut its dividend in the past, most notably in 2020, but has maintained a steady payout since then. Still, dividend investors should keep a close eye on earnings coverage going forward. As for recovery potential, the market seems cautious. Unless Monroe can improve credit performance and stabilize net asset value, it might take time to regain investor confidence. But that also means any positive surprise, like lower defaults or rising investment income, could drive a quick re-rating. At Insightful Value, we deliver sharp, in-depth reviews of overlooked and undervalued stocks. No hype, just clean analysis to help you make smarter investing choices. For more research on Monroe Capital and other potential bargains, visit insightfulvalue.com, and don't forget, subscribe to our channel and check out the website for more hidden value picks.